Hello and welcome to Money Matters TV. I'm Mike Dever, your host today, and my co-host is Skip Massengill of SecureUs. Hello there,
Oh,
Skip.
hi.
Hey, nice to have you. Great having you on the show. I am curious about what it is you're building. Secure Us, and what does that do? What does that mean?
Yeah, thank you. SecureUs is it's built. It's been there. It's partnered with a company called IntraFi. That's a cash management program that gives companies, foundation, large bank balances, security with FDIC insurance. It's been around for 20 plus years, and we have about 3,000 participating banks in the trust structure. We place cash in increments of less than $250,000 with each of those banks electronically to maintain the FDIC insurance across many institutions. We do this electronically. End result is you can basically keep your primary banking relationship. So we don't have to move the banking relationship. CFOs don't like to do that. And all you're doing is moving your excess operating cash into this structure with daily liquidity. And you're not giving up any counterparty risk. So it's very safe and beneficial, and actually pays a lot more in most cases than people receive on their daily balances.
Wow. So okay. So you've still got the daily liquidity, but you're now spreading the FDIC insurance across multiple banks instead of being limited to the primary bank you have, right? Is
Yep.
and that primary bank, do they object to participating in this? They probably want all the money, right? They don't want you to be sending it out to somebody else. Is there any
Uh,
issues with the banks
uh,
and having them
there's
participate?
there's a reason why it's been around for 22 years or so, and people are still hearing about it, right? Um, Banks are in the business of making money. They want to pay me less than 1%, and they want to loan it to you at 7, right? And that's their asset liability management program. That's the spread that they make. And so the more that they can keep in low yielding accounts, money market accounts, low yielding CDs, the more spread they're going to make on that when they lend it out. And as a result of that, many banks that are actually participating in the program don't make their depositors aware of it for some reason. Most of the cases, though, they don't have a chance when the CFO or the board gets involved. From any standpoint, it's just you're reducing all the risk.
Right. Okay. So yeah. So bottom line, the banks are in it for the money. They get the deposits. It makes sense for them, and the corporate get the liquidity, the diversification. How are boards viewing this when a CFO is taking it to the board and saying, I want to engage this program?
It's a pretty well received in most cases, 100%. And the reason is because not only are you not changing the core banking structure that they already have in place, all you're doing again is moving some of your operating liquidity needs to this platform, which can come back on a daily basis if needed. From a board standpoint, it's more important though because you have the FDIC insurance. Forget the fact that you're most likely going to make more money on the return, which in some cases is always inevitable you're going to. But to have the FDIC insurance on the majority of your cash balances, from a corporate governance standpoint, the board can really feel comfortable and sleep at night. You don't have to worry about the news a couple of years ago that a California bank goes under. And luckily, anybody that had over $250,000 was still covered because the government stood up. They didn't
Right.
need to stand up, but they did. In this case, the board can feel very comfortable, based on that corporate governance piece.
Okay, yeah. So, yeah, Silicon Valley Bank, for example, it just really puts some ripples through the banking system. So it actually sounds to me like it should be something that the boards should be asking companies why they're not engaging with something like this.
Well, once a board member finds it, because most board members sit on multiple boards,
Hmm.
so we find that there's an inherent growth that's taken place over these years also. But to your point, yeah, I mean, it just makes sense for boards to feel more comfortable, and it really relates back to also like the auditors of that foundation, corporation, hospital, nonprofit, municipality, public school. You know, the auditors look at that and say, well, why wouldn't you do that? Right. And
Y-
that's where I bring in the corporate governance and said, you're given this You're probably going to make more money. Forget about that. Well, but you're going to be FDIC insured on 80, 85, 95% of your money with absolutely no risk, with a proven track record. And the platform right now sits at about 700 billion, that's with a B, dollar platform.
Yeah, that's my point. I just feel like if CFO is not doing this, the board's got to be asking them, why aren't you doing this? Because of the benefits that are associated with that. So do you see any objection from the CFO side because maybe they have more complications, or is it simple for them to engage this?
It's really simple for them because it's paperwork and a couple, letters of authorization. And because we're not changing banks, in most cases, large institutions have several banks that they're dealing with for different ones, but their main operating account carries that major balance. And with that, we don't see the CFO really in any chance not wanting to do this once they're made aware of it.
Okay, that makes sense to me. Now, you said 800 billion. So obviously this is
700,
getting
700. We're not there yet, but we will be.
707. Okay, yeah. So obviously there's some widespread adoption. Do you see that increasing? Is it becoming more known now, or do you have to sell it, or are people coming to you?
People are coming to us through the auditors, and what's happening is it's just a natural growth and progression. It's not the kind of thing where there's a sales force out there per se from the parent company. All they want to do is garner more banks to join. So they want to go from 31 or 3,200 to 4th. They're the largest out there. They've been out there the longest. But yeah, as the word gets out and we grow incrementally every month because more people are bringing this to attention. Now, when rates were higher, it was even better. Now that rates are coming down, yeah, you're still going to make more than you would. But the reality of the situation is to have that FDIC insurance in today's economic situations probably makes you feel better.
Absolutely. So to me, the extra interest rate's a bonus. The core of it is the corporate governance side of having the FDIC insurance coverage.
Yeah, it really is. It really is. I think that's one of the key things that, from an auditor standpoint, in the investment world over the last 35 years, I've probably gotten 8 referrals from accountants. Why? Because if I'm doing investments and my investment's going to beat that investment, and if I bring in, Brandywine or others, right, at some point there might be a hiccup. But if a CPA brings me in, the client's going to remember that I was brought in by the CPA. That's not good. So as a result, there's not a win-win. Here's a win-win. You get to make more money, most likely, and have FDIC insurance backed by United States government.
Yeah, a double bonus.
Oh, and we have the accounting firms that we talk to. They put their operating millions. They put their operating accounts on our platform, and then they go to their clients saying, "We did this. You probably should too." Right?
Exactly. So, yeah, I mean, right. If it's good for the client, it's good for them as well. Yeah. Okay. Well, great. Thanks, Skip. Now it's time for our viewer question right now. This one comes from James Lewis in Philadelphia. His question is, how do interest rates impact businesses?
Okay. Well, let's frame that for a declining or a rising interest rate scenario, because it's going to have different answers for the most part. If we look at what we're starting to experience now, where rates have come down, they sort of plateaued a little bit. The Fed hasn't stepped it down as much as some people think it should be. But in that scenario, James, what's happening is that the cost of money is getting cheaper, which allows people to do more. All right. And likewise, if rates were going up, your cost of borrowing would go up also. And as a result, you're hindered as a business to be able to expand and grow. When rates are plateaued or coming down, though, in today's scenario, what businesses are going to find is there's going to be more competition. Why is that? Well, the competition arises from people that can reduce their cost to carry, whatever their business is, because their rates are going to be to borrow money are less. So they can stay in the game longer. And so what happens is the businesses that we see are going to continue to grow, but the little ones may stay around a little longer because of these falling rates. And as that takes place, the businesses are then going to start to have to project, how long can we be in this game? Where can we be? And then the other thing to put in place also is to maintain your banking relationships as a small business. working with the bank, working with the SBA lenders that basically guarantee 20 to 30% of the bank's loan, so the bank can feel more comfortable going to these small businesses. You can see a lot of what's happening in the economy, that the small businesses are the ones that grow and grow up and get bigger. So
Right.
we'll continue to watch.
All right. Hey, thank you very much, Skip. Now, if you would like to ask a question of Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Thank you and welcome back. Thank you, Skip. Okay, go ahead. Yeah, so now we got Skip back in here. So now we want to go into the second part of the show. I think Skip had some questions. We were going to talk a little bit about what we're doing here.
Yeah, no, would appreciate your time today. I think for our viewers that might be new to understanding Brandywine, give me sort of the cleanest one-sentence description of what you guys are doing.
Yeah, so at Brandywine, we manage an investor's money based on the concept that reduced loss equals increased return. So everything we do has always on downside protection, but unconstrained upside exposure.
Okay. It's pretty interesting. Most people have been taught that you want to reduce the loss, and as a result of that, you have to give up the gain. So, I mean, if you're giving the gains, but you're reducing the loss, let's dive into that a little bit more, please.
Yes, so that's something that's unique. We developed 5-10 years ago, and you're absolutely correct. If you are doing something conventional to reduce loss, such as reallocating some of your risky assets, high tech growth stocks, for example, into something more conservative like bonds or value stocks or cash, you will absolutely reduce your risk, but likely reduce your returns as well. And there's buffer funds and things that are out there as well that protect the downside, but they cap the upside to pay for the cost of that protection. What Brandywine does is a little bit different. It's an investment process we call risk replacement. And I can show you here in a couple slides real briefly what exactly that means. And
yeah, I want to know what risk replacement is. Okay, that's
I mean, it's a three-step process, Skip. We start with exposure to the underlying benchmark index. So, for example, if somebody wanted to capture the returns of the Russell 2000, a small cap index, we just buy that index. Then we add put protection on that. So
okay.
this is similar. It's just by buying puts, you end up with downside protection, and we can see here how much that might protect you in the case of different losing spells, for example.
Yeah, I think that chart really is showing, because I think if let's look at the 6/30/2020 dip there in the middle of the screen.
Yes.
And for our watchers, when you buy a put, you're basically saying, hey, if the market does that long, we see that downward spiral, we're going to be able to take our position and put it to you at a price before we lose the money, right? So
right.
That's your protection. But
it is, and you can see the magnitude of the protection on the next slide, where if you have, let's see, yeah, but here we go. If you have some protection in there, those losses, like the 2022 bear market you're talking about, you might prevent a quarter of that loss. More sustained, prolonged, deeper losses, the put protection even adds more value to where you might protect against half the loss in those markets. And what that means then is, first of all, you're recovering from higher levels.
Sure.
It's like starting the 100-meter dash on the 30-meter line
Right.
when it's recovering. It makes it a lot easier for investors to hold their position through that and not bail out. And if somebody's near in retirement or in retirement and they're taking some money out every month to fund their living needs, it's not eating up as much of their principal when they take out that 4%, 50% drawdown. Now that's 8% they're taking out each year. They're not eating into that principal nearly as much with that reduction.
And given your thought process of starting on the 30-yard line versus the zero, what's the cost to get out there to the 30-yard line to be able to buy those puts, and how does that affect the overall return? You're protecting the downside, obviously, but there's got to be a bit of a cost to buy the puts, right, from the returns?
There is, absolutely. So in a bull market, when you're buying puts and they're not adding any value, they're expiring worthless year after year after year, it comes to about 2% per year. And so that's what leads to the third step that we have in the process. In the third step, we have what we call return driver diversifier. This is an overlay strategy that's just embedded in the product, where it's trying to earn a few percent per year, enough to pay for the cost of those puts in a bull market. And it's a diversified portfolio, uncorrelated to the underlying benchmark, that actually has substantially less risk than the benchmark because of that diversification, and the fact it's only trying to earn 2% a year just to pay for the cost of the puts. So you end up with that offsetting potentially. It doesn't do that every year. It might have years where it doesn't cover the cost of the puts, but potentially covering the cost of the puts over time, so that you don't reduce your bull market performance. You're able to match performance over time. And the reason we call this risk replacement is because we start with the risk of the underlying exposure, we offset it with the put protection, and replace it with the lower risk of the return driver diversifier.
Okay, and now, do you have competitors that are doing similar?
So right now, no. This is interesting. This is one of those innovations. If you think back of the progress over the last century with fund management, in the 50s, the 60s, into the 70s, it was all active managers trying to pick hot stocks and buying and selling actively to outperform the market. And then you had Bogle come along and Vanguard and say, hey, we can do this passive investing. Now that had solved the need. These active managers weren't really keeping up with the market, and they still had a lot of risk. The problem with passive investing is you're exposed to that naked risk on the downside. Your market drops, you're going to match the market on the downside as well. What risk replacement does is take that underlying beta exposure, matches that as closely as possible, and then still has some downside risk protection in it. So far it's an innovation that hasn't been copied. It absolutely will be over time, but we've been doing it for half a dozen years now without the competition. But as it gets recognized, it'll start absolutely getting copied.
Yeah, I mean, you're almost the opposite of the active investor. And if I'm a fund manager and I'm trying, to your point, pick the top stocks, and it's going to be the top 8, right? The S&P 500, and it's when you get in, when you get out. But the reality is that if you're, I've always learned that if you can protect your downside, your upside is a lot easier to think about, because most people really don't need a 10, 12% return. They just need to be coasting along and not lose money. And if you don't lose money, to your point, you're always starting off a little higher and not worried about that. That risk constrained. Go over that a little bit more.
Yeah, so that is absolutely the most important part. If you talk to some of the top hedge fund managers and stuff, their comment is always cut your losses short, let your profits run. And the active managers that are trying to pick hot stocks, the passive funds that don't protect the downside, aren't doing that. So instead of trying to pick the hot stocks, you said it exactly. It's the opposite. Instead of trying to pick hot stocks to outperform, we're saying, no, we're going to protect the downside and then just try to match the upside performance when that occurs. And it's a totally different philosophy. It's a totally different approach. That is the opposite of what an active manager does. And the other reason that that's really good is if you look at active management, and S&P Dow Jones publishes a persistence report every year, and they show that the longer you're with an active manager that, say, outperformed, was a top quartile performer, top quintile performer over a 5-year period, over the next 5-year period, it's less than random whether or not they stay in that. And it decreases with time. So the
Wow.
longer you invest with an active manager, the less likely they're going to outperform the benchmark over time. And I view that as gambling. I mean, that's what a gambler sitting at a table. The longer you play, the more you're going to lose.
Yeah.
And that's what that's showing. So we want to do the opposite of that. We want to do something that mathematically is supported by, okay, you reduce the loss, recover from higher levels. Over time, you outperform.
Yeah. Now, and I'm, with my cash management, we're talking to an awful lot of big foundations, pension accounts, et cetera, that have idle cash for certain reasons, just based on their asset allocation. And so the same thought here is if you didn't have to worry about losing that, in this case would be the same. I was doing some research when I found out we were going to be on the show together, and you had written a book that I found very intriguing. One of those thoughts there was chasing that momentum, getting, how do you basically save yourself from doing the wrong thing when you're making these investments? And you had a couple good rules, I think 5 rules that you were talking about, which could be applicable, I think, in this case also, right?
Yeah, well, I think the main thing, that I try to stress through the book is that you need to have a plan. You need to follow a process. You don't be reacting on a day-to-day basis. Don't get emotional. If you can do that, you're like more than halfway there, because the average investor underperforms the very funds into which they invest by as much as 5% per year. This Dalbar study does this year after year. They publish this in rolling 20-year windows. When I published it with the book initially over a decade ago, it was in that 3 to 5% underperformance range. It's maintained that again now, a decade
Amazing.
later. It's just so consistent, and it's because investors will jump into the funds that are the hot funds or the hot stocks just in time for them to reverse. And as we talked about just a couple minutes ago, active fund managers, the longer you're with them, the less they're going to outperform, the probability that they're going to outperform. So if you're picking an active manager that was hot, the math is saying that you're more than likely going to underperform going forward, not outperform. That's just really key.
I definitely would concur with your thought and thesis there, because the reality is that people do pretty much exactly what they shouldn't do at exactly the wrong time because of emotions, because of perceived history, because of perceived information. And, advisors, for the most part, don't come in saying, let me sell you a boring investment that's going to make you money. Right? No. They come in saying, I've got sliced bread. This is going to be great. But
exactly.
If you're lactose intolerant, that might not be that great. But from a protection on the downside, I would think as we move into more uncharted waters with the government, the economy, what's happening everywhere else, that the flow to your funds has to be increasing, because people are should be looking for that downside protection. And it's almost like the scenario where I have, once you tell the story, they go, that makes sense. So it's almost, our stories are the same of like, why isn't the money flooding in? Because people don't think about the risk.
Yeah,
they always think about the reward, and the reward, as you said, is diminishing over time.
Absolutely. And we have had individuals calling us and asking about, hot performance. They're in that mode now where they're afraid of missing out on the upside because the market keeps hitting these new highs, and they want to participate in that. Reality is, this doesn't preclude that from happening. But if things flip, they always do. I mean, there will be another bear market. You want to have that downside protection. You don't want to be panicking when that happens. And the intent here is that you prevent scenarios like the double bear market in the 2000s of just destroying for a decade investor wealth. The market fell, dividends included, throughout that decade. So having protection in there, you have the potential of actually taking a period like that and turning it into a bull market. Positive returns over time, just because you're truncating those 50% losses to 25%.
Yeah, and I think for the small cost or the premium of the puts, but still maintaining that 100% upside, which again, the put cost is going to take a little bit away from. But as you said, to be able to maintain that portfolio and really sleep at night, right? And not worry about, we wake up to NVIDIA, something wrong, and that's it. So those are the positions. Do you also, I know you do some work in real estate REITs and some bonds and structures, the same strategy with those markets?
Yeah. So for us, it's really, we have, we're focusing on the equity markets and fixed income primarily.
Mhm.
And so we have a suite of funds that have been used as in 401k plans for last number of years now, that the clients use them as replacements for the existing funds they had in their portfolios. They simply remap to Brandywine
Mhm.
because they have the same, it's a really high correlation to what those underlying benchmarks are, but they have the downside protection. And now we're doing the same thing in an ETF suite. So people can access it. All wealth managers, model portfolios, other people can invest in it, that way as well. But we're starting to see. You mentioned earlier about the flows and investor interest. It's really already picking up for us at this stage without exceptional outreach. And I think part of it is the people's concern about valuations. And if they see that you can match performance anyway, I actually have a slide here. It's kind of interesting. That shows what the concept can yield with this slide here. It talks to capture ratios.
Yep.
This is the big difference of what this strategy can do. It can enable people to capture almost the entirety of the upside, but just dramatically reduce the downside loss in the portfolio. That's again the entire philosophy: reduce loss equals increased returns.
Yeah. No, it's should have another box there that's red underneath the line showing the loss you would have taken, right?
Right. Yeah. No. It's and that's what we showed that with that earlier slide with the put protection.
Yeah.
What's being mitigated. About half the losses are potentially mitigated in that downside protection.
Yeah, I would think I do a lot of work with Don Trone, who's the godfather of the fiduciary movement, and Sean Hannon, who's a retired colonel. And it's all about doing the right thing and being there as a fiduciary. And if I'm an advisor on a pension plan, I'm going to have to be looking at this, right?
Absolutely.
Because it's if you're buying A versus B, and once it's known, same thing with the cash management, it's almost like, well, why doesn't this make sense? I'm giving up a couple percent maybe, but I'm protecting a 50% loss, a 20% loss, whatever it might be. I would think that a lot of the 401k plan advisors, as you mentioned, have to be knocking on your door.
Yeah, no, that's exactly right. Now, we're fortunate to have Don Trone, father of fiduciaries, he's been called, on our advisory board. He's a great asset. He's really led the whole industry. We had one investor point to some of our charts and say, this is all you need to show to your clients. Just say, you're the fiduciary, you make the decision. So you're right on that. Well,
Yeah.
thanks, Skip. It was great. I appreciate the show. Again, we immediately run out of time. It seems like right when we're talking about things that. Thank you for being on the show.
It's great.
And thank you for helping me describe what we're doing here at Brandywine.
Wonderful.
Thank you. So our next guest on Money Matters TV is David Fries of Unruh, Turner, Burke and Fries, and he will talk about estate planning. Until then, thank you for watching Money Matters TV, where your money matters. See you next time.